If you have any money in the market, you need to hear this. Despite the stock market hitting all-time highs, search volume for AI bubble has just broken a new record. Many investors believe the economy is now on borrowed time, and billionaire Paul Tudor Jones says this moment feels a lot like what happened right before the 2001 dot-com crash. That's why we need to talk about what's happening, what could be next, and why some people might face a rude awakening. Even though it feels like stocks only go up and AI is the future, most people are not prepared for a downturn when years of gains can be wiped out in weeks. Today, I'll explain the facts and share what I believe to be the best strategy moving forward. But before that, make sure to like this video and subscribe. It really helps the channel. Thank you so much. And here's a picture of a turtle as a small thank you. Now, let's talk about the dreaded market bubble. This usually happens when enthusiasm, excitement, and money all mix together to make one sector skyrocket in price. What we're seeing now is truly incredible. Consider this. OpenAI recently raised money at a $500 billion valuation. They then committed $300 billion for Oracle Cloud Compute. Oracle stock jumped because it uses NVIDIA chips. NVIDIA's demand surged, and NVIDIA invested $100 billion back into OpenAI. To make it even stranger, OpenAI owns 10% of AMD. Intel is partnering with AMD, and the US government owns 10% of Intel. In simple terms, it's like Paul invests $100 in John, John invests $100 in Bob, and Bob invests $100 in Paul, a circular loop of money. Here's the problem. Tech now makes up more of the S&P 500 than it did at the peak of the 2001 dot-com bubble. NVIDIA, the largest weighted company, trades at a price-to-earnings ratio of 57, meaning investors pay 57 times what the company actually earns, betting it will make even more in the future. Another measure, called the Buffett indicator, compares the total value of the stock market to the US GDP. A reading of 100% is fair value, 70% is cheap, and 200% means investors are playing with fire. Right now, it's at 217%, the highest in history. Some argue this indicator is less accurate today because it doesn't account for low interest rates, but experts still warn that such high valuations can't last forever. Across the S&P 500, the top 10 companies now make up more than 40% of the entire index. So even if you think you're diversified, most of your money is tied up in just a few companies. So how does this compare to past bubbles? The 1999 dot-com crash is the closest example. Back then, investors poured money into internet companies that were unprofitable. And when the hype collapsed, tech stocks lost an average of 78% of their value. It took nearly 20 years to recover. Today's market feels similar, but not as extreme. The Nasdaq's price-to-earnings ratio in 1999 was 75. Today, it's 35. Cisco, the top tech stock in 2001, traded at 472 times earnings, compared to NVIDIA's 57. So while valuations are high, they're not as absurd as they once were. Still, investors are throwing money into companies that don't make profits. A recent MIT study found that 95% of companies saw no measurable return on investment from AI. This means we're starting to see a gap between investment and productivity again, just like the early 2000s. Some also compare this to Japan's everything bubble in the late 1980s, when their stock market tripled in a few years before crashing by 80%. It took Japan nearly 40 years to recover. While the US isn't in the same position, the psychology feels similar: overconfidence, easy money, and speculation. So what does this mean for you? How should you prepare? No matter what happens, it's always wise to diversify, not just across stocks, but across asset types. For example, BlackRock has argued that a small allocation to Bitcoin might hedge against global instability. Now, are we in a stock market bubble? By most metrics, yes, valuations are extremely high. About 60% of venture capital is now going into AI, compared to 40% that went into internet startups in the 90s. The Fear versus Greed Index is showing greed, and price-to-sales ratios are back to levels we haven't seen in decades. Some argue this is just the result of money printing, since the dollar had its worst year since 1973. But when you look at the data, that's not the case. Over the past 50 years, the dollar and the stock market have shown almost no long-term correlation. Fisher Investments found that the relationship between the dollar's value and the S&P 500's performance is nearly zero. What about inflation? While it affects short-term prices, long-term data shows no strong link between inflation and stock market growth. That means the stock market's rise can't be fully explained by money printing. It's genuinely expanding. So, are we in a bubble? The truth is, we usually can't tell until after it bursts. The market could stay irrational much longer than you think. For perspective, if US stocks traded at Japan's bubble peak levels, the S&P 500 would be over 11,000 points, nearly double where it is now. There's also about $7.7 trillion in cash sitting on the sidelines waiting to enter the market, and AI is being driven by highly profitable companies like Google and Microsoft, not speculative startups like during the dot-com era. Still, it's smart to be cautious. Make sure you have a steady income, keep investing regularly, and diversify. If the market drops, use that as a chance to buy more at lower prices. Personally, we follow a simple rule. The market can stay irrational longer than you can stay solvent. It's almost impossible to time a crash correctly. Even Isaac Newton lost money in the South Sea bubble by selling too early, buying back in at the top, and losing everything. So my approach is to keep dollar cost averaging, investing consistently, regardless of market swings, and to diversify across multiple sectors. I also invest internationally, in emerging markets, and in Bitcoin ETFs, while keeping some cash in tax-free municipal bonds that earn 3.5 to 5% annually. That way, I'm still growing my money, but also have cash ready to buy more if the market falls. It's like insurance. You give up a little profit now for protection later. From all the data we've seen, the stock market is definitely expensive and may be hard to sustain, but that doesn't mean it can't go higher for years to come. Historically, betting against the market has lost more money than it's made. Then again, we could be wrong. We are making videos to provide information. Let us know what you think in the comments below. Don't forget to hit the like button and subscribe. Thanks so much for watching, and until next time.